Good morning, everybody, and welcome to this week's weekly analysis session for the Elite Traders Club on Monday, the 5th of October 2015. Hoping everybody had a pleasant weekend. It was a very warm and sunny weekend in Melbourne, and I'm pleased to say that Hawthorn took their third Premiership Cup in a row, so well done, Hawthorn. The markets this last week, wow, what a volatile market it certainly has been. Some days the market is up 1%, then it's down 1.5%, then it's back up another 1%, and so on and so forth. The market continues to move up and down, particularly the US markets. On Friday in particular, the market's opening down a couple of hundred points, only to rally and put on about another 300 or 400 points by the end of the day. A bit of the old bad news is good news type of scenario happening at this point in time. Let's get underway. All right, the disclaimer first. The content of this presentation or any other Elite Wealth material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances or seek further advice on its appropriateness. All right, that underway. Portfolio management. There has been a change to the market risk levels in the US. We'll go through and have a look at that in a moment. I couldn't find any new setups in either the Australian market, the ASX, or in the US either. Such as the price action at this point in time. There are a couple of cancellations which we'll go through, and then obviously any Q&A as well. So the ASX 200, we've been in extreme risk for probably a couple of weeks now, and just recently the S&P 1500 has just dipped down into extreme risk as well. So as far as bull markets, bear markets, we're certainly in bear market territory. Those market risk multipliers, they are important in that they tell us how much risk we should have exposed to the market, particularly if we were starting off our trading right now. So assuming that you hadn't been into the market at this point in time, a lot of people, when they're learning about the markets, etc., very keen to get their capital exposed to it. The market risk indicators are telling us, look, it's extreme risk at this point in time. It just doesn't make sense to go and expose all your capital to the market under these conditions. And that's a significant point of difference from perhaps what you may have done in many years gone by. Certainly, my firm belief is that if you've been in the market for a period of time and you already have positions established over the last 6 months or 3 months or 2 months or whatever it is, that you continue to manage those trades as per normal, that you don't try and ram, cram and jam, because all you're doing is you're asking yourself to be stopped out. So I think you just need to continue managing your trades as per normal, that is, giving them a wide stop using that 3 ATR, trailing it on the basis of that. Yes, you will sometimes give back a little bit more than what you want to, but on the other side, the flip side of it, which is really, really important for your overall expectancy, remembering that's going to be a product of your average win versus your average loss, also incorporating your strike rate as well. So the strike rate is really not that big a deal in that overall equation. It's more about what your average win is compared to your average loss. And so remembering our job as investors, as traders, is to keep our losses small. That's the number one priority, protection of capital. Keep your losses small, be patient, let those profits run. And if you do that over the times when we're in a good market, over the bull markets, when they occur, then you'll find that you'll bank some nice profits along the way. It won't happen on everyone, but at least you therefore allow the opportunity of those bigger returns to enter your portfolio and boost your overall expectancy. And that's a really important concept. At this point in time in the ASX, we are in extreme market risk. And as you'll see, that means a 10% market risk multiplier. So again, assuming that we're splitting our capital 50-50 between Australia and the US, that means that we could expose up to 7.5% of our capital to the Australian market if we were in a low risk market. regime. At the moment, we are in extreme risk, so we're only allowed to use 10% of that 7.5%, meaning that if we were starting off trading right now, you'd only be spending, you'd only be allocating, if you like, or exposing 0.75% of your overall capital as value at risk in the market. Naturally, over a period of time, if you've been in any trades, you'll be stopped out along the way if the market has chosen not to support the stocks that you're in. That's okay, as long as you're managing your risk, protecting that capital, so that if the market really gets very, very ugly, you're not going to donate it like everybody did during the GFC. Very, very important. All right, so let's go through and have a quick look in the US. As I said, we're in extreme market risk conditions there at the moment. So again, if you're allocating half of your capital to that market, at the moment, you'd only be allowed to spend. Where am I getting the spend from? Having just bought my daughter a pair of runners that she wanted, so maybe that's where the spending's come from. The extreme risk, you're only allowed to expose 10% of your maximum allowable drawdown. So assuming if you were exposing 7.5% of your capital to the US in a low risk market condition, because we're in high market risk, you're only allowed to expose 10% of your 7.5, which means 0.75%. So it's the same in both markets at this point in time. So let's go through and perhaps have a bit of a look at the market risk on the on Beyond Charts. So I'll just jump in and have a look at our two market barometers, if you like, our benchmarks at this point in time. We'll go back up and just have a look at the XJO to start with. At this point in time, you'll see the story for the last few weeks is that we've been in extreme market risk territory. You've got to remember that this stochastic, it is a bit of a lagging indicator. The most concurrent indicator that you'll ever get is price action in itself. And you've only got to look, you'll feel this yourself if you've been in the Australian markets, that, no sooner do we have a series of white candles than we get black candles, and then white, black and white, black and white. It's really starting to look very much like a bit like a piano keyboard, isn't it, with the amount of black and white keys sort of intermingling there. Certainly had a down day on Friday, but I think you'll find that we have a fairly strong day on the market today, given what happened in the US over the course of on Friday night in particular. So I'll just go through there and you'll see that big white candle coming through on Friday night. Market was no sooner did it open, and it was really had been belted down pretty significantly. It was starting to look pretty ugly, and it was looking like we were going to get the formation of another lower peak, which would have been quite bearish. But since then, after we had non-farm payrolls, etc., coming through, market took off, realising that the numbers weren't that good, and that perhaps that may well mean that we have lower interest rates for a little bit longer time in the US, and as a result, market rallying on the basis of that. So the old bad news is good news type scenario there. Again, you'll see as well that the stochastic, it is lagging. It's just dipped down into extreme risk territory in the last 2 or 3 days, and since then the US has produced actually 3 very nice candles. So I'll be interested to see how long this stays down here before it actually starts to turn up, and what sort of strength, what sort of follow through we get. And hopefully we do get a good degree of follow through that can at least see us retesting the level of our longer term sort of bull market, bear market filter, the longer term moving average there. So that's a quick look at the main indices there. As I said, I went through, ran the scans over the course of the weekend. I couldn't find anything at all in the Australian market or in the US, which is not terribly surprising. And even just looking at the results of just your blanket scan results that you get from Beyond Charts, the numbers that are being spat out there are very, very low. Even in the US, the total number of scan results that are pumped out was only around about 50, which is very, very small. And so from that 50 going through that list, there was nothing there that met any of the criteria. So again, that's just another bit of feedback for us, other than our benchmark indices, our market risk models that we're looking at, telling us that at this point in time, look, the trend really isn't to the upside. It's very much more to the downward side. So let's just protect that capital and be cautious in what we're doing, but continue to manage our trades in the appropriate way. A couple of cancelled orders that there were, though, which we might go through and have a bit of a look at. These are ones that have been in the watch list recently. SIG was one from a couple of weeks ago, so we'll just go and have a look at that one. So we had an on-stop order a couple of weeks ago on this one, and you'll see that last week's candle, we're now in short-term downtrend, and as such, we've just put in another peak. And irrespective of where that peak is compared to the previous one, our short-term downtrend, wherever this ends, we're going to have, by default, a lower trough. So remembering we must have higher troughs when we're looking to enter a trade, and that on its own is sufficient to invalidate the trade setup. So there's a cancellation there on SIG. A couple of other ones. FIS, I think we looked at last week as well, but I'll just go through and have a look at that one just in case anybody missed that. Fidelity National. And again, last week we did have a lower high and a lower low, so putting us into a short-term downtrend. Certainly last week, a much lower high and a significantly lower low, well entrenched in short-term downtrend, and as a result, it means that we've also put in a lower peak. We've got lower peaks, and again, that voids the price action aspect of our entry strategy, if you like, or our entry orders, and so therefore that one needs to be cancelled as well. MD was another one, Mednax, so we'll go and have a look at that as an example. Previously we had an on-stop order at 86.11, and just to go through and just confirm that for you, the high there, 85.97, so we didn't get to that expected top, if you like. It sounds a bit like a weather report. We didn't get to that on-stop order at 86.11. We've now put in a lower high and a lower low, so we're in short-term downtrend. That's okay. However, the point is, in doing so, we have, at the same time, we are going to, by default, with this short-term downtrend, we're going to put in a lower trough. Wherever this trough happens to form, it's going to be lower than the previous one, and again, that invalidates our price action filter. CMG, which is Chipotle Mexican Grill, that was one that recently had been in the watch list, and again, exactly the same thing occurring there. Lower high and lower low. We're in short-term downtrend, and quite clearly on this particular setup, we've now got a lower peak, and as such, that invalidates the price action filter as well. A couple of others. I think we also had BCR, I think was one that was in the watch list there, and we'll just go and have a quick look at that one. When you're ready, beyond charts, I'll keep my fingers crossed it doesn't take too much longer. There we go. So in this particular setup, we've got now formed a lower peak, and again, same as before, invalidating the price action. A couple of stop outs in the US last week. CSL was one of those. CSL Limited. No, that's the Australian one. Carlisle Companies. We'll go through and have a look at that, what happened with that one during the course of last week. And again, the market's been very volatile, and as a classic example here, where the 3 ATR trailing stop had moved up beyond our initial trigger point, certainly moving up well beyond our initial stop loss, and for a period of time really this stock had gone sideways, really struggled, and then started to move more in alignment with the market in recent times, and last week closing below its trailing 3 ATR and getting us out pretty much at about break even on that one along the way. If you did happen to take that particular trade, there was a price volume volatility signal at around about $102, so getting in at around $90 and perhaps taking a little bit of profit there at 102. It's giving you around about a 15% return on that price volume volatility if you happen to take that. Certainly not a huge amount, but again, keep it in mind in terms of what your initial risk is. So most of our stops are around about that 10% sort of distance away. So you really don't want to be taking any profit off the table before you get to a minimum of 1-to-1 as the barest of minimums. But needless to say, a scratch trade. Did everything right, gave it as wide an opportunity as possible, as patient as possible, and that's how you grow your portfolio. Occasionally you're going to get trades that do this and go the other way, but it's important to keep managing your trades in the appropriate manner. A couple of others in the US that got stopped out. EBS, Emergent Biosolutions. Again, that was one. A couple of weeks ago, it breached its soft stop. And as a result, that soft stop got converted to a hard stop. Now, that's a rule that's been in your trading plans pretty much ever since day dot. I will be reviewing that and running an education session on that over the course of the next week or so. Those of you who didn't catch up with the education session last week, I've made a small amendment to the way that we place our on-stop orders. So rather than the traditional 2 pips above the high of the last medium-term peak, we are moving to a percentage-based model. So from now on, any orders that we place will be triggered using, rather than 2 pips past the last medium-term peak, we will be using a percentage, and that percentage is 0.5%. So the beauty of that is that it helps to keep very much consistent, particularly when we are looking at stocks like NVR as an example last week in the US market. There's a stock there around about $1,600. Getting in on stop with 2 pips above the high of the last medium-term peak. 2 pips, that's 2 cents. 2 cents on a $1,600 stock is totally insignificant. So moving to a percentage-based model makes so much more sense. It makes it easy as well, because remember that when we're placing our protective stop, that we need to be below the last medium-term trough, and how far below that? We need to be at least 0.5%. So just keeping things nice and easy to remember, nice and easy to do, just helps us to be a little bit more consistent in our trading and application of good trade management. So I think that's important. Another one in the other one in the US that got stopped out was an ETF actually, and this is one that's been in the portfolio for a while, PSCH. And this was a small cap healthcare, sorry. This one was. So this is one that had been in the portfolio for since around the beginning of the year. Quite a lot of price volume volatility signals going off along the way, reaching a return of around about 20% when they were all going off at those particular levels. So an opportunity there, given again that our initial risk on the trade was around about 10%, to take a little bit of profit off the table. You might remember back at the beginning of September, we had that extremely volatile week on the market. ETFs are basically if you like, they're a bit like a mini managed fund or a low-cost managed fund. And during that particular week, because of all the stocks that are part of that ETF were all plummeting, going down, up and down, very difficult for the ETFs to get a unit price, if you like, on the value of each of the shares in that ETF. So a lot of volatility midweek, particularly during the course of that week. And interesting that price opened way down and during the course moved even further and further down before closing up with a big white candle. So the rule that we were talking about earlier that I'm going to make some changes to over the course of the next few weeks is this breach of the initial 2 ATR. Now obviously this one's been in the portfolio for a while, so we don't need to worry about our initial 2 ATR. It's all to do with our trailing based stop. But suffice to say, tried to do the right thing and regain some strength, but the last 2 weeks again has suffered a little bit with the overall market, and last week closing below its trailing stop. But again, still eking out around about a 15% profit on that one at the end of the day. So that's PSCH. A couple of trail stops in the Australian market. No prizes for guessing which ones they were. Really interesting. I'll just go through the Australian portfolio and then we might go and have a look at the American portfolio on a wider basis here. CZZ, Capilano Honey, it's been a lot of interest in this stock, and hasn't quite put in a strong enough candle last week, but still holding up very, very well. A couple of price volume volatility signals there going off, so if you're in this and you haven't taken a little bit of money off the table yet, certainly worthwhile considering given how much profit there is on that trade as we speak. Auckland International Airport. Last couple of weeks had been pretty good. Last week finding a little bit of weakness. It'll be interesting to see what happens with that over the course of this next week if that continues to move up. But again, looking at this over the longer term, this 3 ATR, we've talked about this in previous occasions, has held up really, really very, very well. And even this little black candle down here still managed to close above the trailing 3 ATR. So being patient will reward you with those longer term winners, and that's what's going to make a significant difference to your overall performance. ARB starting to pick up a little bit. You'll see the relative strength there compared to the broader market. Good candle last week. It'd be really nice if we can get a close above this 1450 level. That would be certainly very strong for ARB. BWP just struggling a little bit at this point in time. It is still a little bit of a distance away from our trailing stop. It'd be nice to see that get a little bit more strength into it as well. GHC, very interesting. You'll see the trailing 3 ATR has just moved up marginally over the course of that last week. Nice candle, nice bullish pin bar there, looking very, very good. A price volume volatility signal on the previous week's candle as well, GHC. And again, just zooming out and look how well that trailing stop keeps you in a trade. So again, just being patient, and this is where you're investing, where your trading can be quite boring. You look at it every week, nothing to do, trailing the stop, nothing to do. And that's how you grow your portfolio. So if any of you have been in that, congratulations. Continue to stay in it. Nothing else to do. Enjoy the ride while you can. GOZ, some tails on these candles. Really need to see some follow through. Really not doing a hell of a lot of late. James Hardy, again, some tailing on the top of the bodies of these candles. It'd be nice to see that turn around and start to move up again as well. AZJ, we got triggered in through this level here. It's really just trying to hold its head up as we speak at the moment. We did have a breach of a soft stop earlier, certainly last week, showing us that there's a bit of demand for this still, so hopefully that can continue to move in the upward direction. It's beyond charts as being a little bit strange. AHD, at this stage, the ATR trailing stop there is still at the same level, just waiting for a higher close. APE, again, if we just sort of zoom out and have a look at this, certainly a lot of sideways movement. It's moved up quite strongly from the beginning of the year, whilst the rest of the market also moved up strongly. Since that point, our market, particularly since sort of April, May, has really struggled. This has continued to sort of move in an upward direction, albeit sort of haphazardly, showing still very good relative strength by and large. MNF, MyNetPhone, a stock that has really been given every single opportunity to do the right thing. It has just put in a higher trough. So fingers crossed that can start to regain a bit of its strength. Certainly the $4 level at the moment is key, given that we've got these levels of overhead resistance or points of supply along the way. That's MNF. The star of the portfolio at the moment, Blackmores, just continuing to go up and up and up. So again, those of you who are in it, absolutely nothing to do. There was a price volume volatility signal from last week, so if you hadn't taken some partial profits along the way, certainly you could consider doing that. Nothing the matter with taking some part profits and looking for an opportunity as it presents itself to get back in. So going along very, very nicely there. Much higher closes, and as a result, just continuing to drag that trailing stop just skywards more and more. So performing really, really nicely, BKL. We'll go through and have a quick look at the US portfolio. Again, I think it's important to go back and have a look at a number of the stocks across each of the portfolios and just see how they've been performing. Again, very important to be thinking about what our objectives are in terms of managing a trade, being patient, and looking at the good and the bad to really give ourselves a good context of the importance of appropriate trade management. You'll see this one here, Arch Capital. It's been performing very, very well. It did have a couple of weeks where we had those pullbacks during end of August, beginning of September. Threw in some pin bars. Certainly at one stage looked like potentially giving back more than what we wanted to, but since then rebounding very, very strongly. Last 2 weeks candles being really, really very, very nice. We have got an interesting point here that I just wanted to illustrate. We do have now a much higher close, which typically means that it's going to drag our trailing ATR up. The other component of this you need to be thinking about is that it's always going to maintain a minimum of a 3 ATR distance from the close of the candle to where the stop is. So now that we've got a higher close, why hasn't this trailing 3 ATR also moved up as well? Well, the reason is, and you'll see this down below, is that our ATRs at the same time have been increasing. So whilst the candle close is higher, you would believe that that would drag that ATR up, but at the same time we're getting an expansion in the average true range. So that basically really in layman's terms just means we're getting an increase in volatility, that's upwards and downwards movement, at the same time that we've had this higher close as well, and as a result that trailing ATR, remember it doesn't go down, has remained at the same level. So that's Arch Capital, still going very, very nicely there. ALR, again, last week we had a black candle. Last week prices moved down below our trailing 3 ATR trailing stop, only to find some demand and coming back in and closing with a fairly nice candle. So if we get a bit of strength into the US market this week, then that's starting to look favourable again. BIO, Bio-Rad Laboratories. And again, it's one of the reasons why I don't particularly like the rule with the soft stop converting to hard stop, is that whilst we breached our initial 2 ATR stop, therefore it means that we put in a hard stop 0.5% below the low of the candle that penetrated the initial soft stop. So the initial stop on this was 139. We use our rules of breaching the soft stop. It means we've got to have a hard stop down here at 130. So whilst we got in nearly at $150, $149, if we end up getting stopped out at 130, that's a much bigger loss than I think we need to have. So again, I'll be running an education session, if not this next week, the week after, just on a small amendment to that, so that we don't end up with these situations where we're giving back a lot more than what we need to. So I'll certainly go through and give everybody a pretty good heads up on that. Casey, nothing to do there at the moment. even though we've had a couple of candles of late that haven't been all that flash. CHD, nothing to do at this point in time. A little bit of a wick on that last candle, so certainly a little bit of demand there seems to be appearing. This was the one that we looked at before, CSL, closing below its trailing stop there, so that's an exit at market tonight. CTAS holding up pretty well given broader market weakness. CYT, that's under the process of being taken over. DOX, again, during the course of that last week in August, first week in September, moving against us, moving back up, and clearly well above that trailing stop as we speak. Just needs to find a little bit more strength, and if the market continues to do the right thing, should find it. Domino's Pizza, it's held up extremely well. EBS, this was one that, again, breached its soft stop, was converted to a hard stop, and triggered that last week. EFX, similar sort of thing where price came down. At one stage was trading below our trailing stop, has since come back, found some strength, and starting to move upwards again. Nice candle last week. FISV has been in the portfolio for quite a period of time, managing to hold up reasonably well given market dynamics over the last few weeks as well. G3 certainly just starting to weaken a little bit over the last month. We'll keep our fingers crossed for that one, and that it closes above the trailing stop. Nothing to do for the time being. HCC, that one is under takeover. GPN, again, a little bit of weakness towards the end of August, like all the other stocks, but since then really powering away. Very good relative strength. Nothing to do with this. We do have a higher close on this, but again, because we've got the ATR expanding as well, just due to natural volatility. Remember, volatility is non-directional; it's up and down, and as a result, not yet dragging that 3 ATR upwards at this point in time. ISBC, certainly it's a little bit like the Leylands. This one's been all over the countryside, but is certainly holding up pretty well and has rebounded nicely from that 3 ATR line back in an upwards direction. And if you're patient and follow your rules, then you'll get those benefits along the way as well. JAH, a little bit last week, testing the trailing 3 ATR, managed to find some demand. Hopefully, if we get a good week this week, that'll start to push that up in a higher direction. Lennox International coming back down, still closing above the 3 ATR. Nothing to do at this point in time. A little bit more market strength should push that to the upward side. If not, if it happens to close below, then we'll get out at market the following week. MANH, big retracement, moving back up. A bit of a pin bar last week. Be nicer to have a white body on that candle, but again, all things considered, going along pretty well. Massey at this point in time, just struggling a little bit. You'll see the relative strength there just coming off. So it needs to do a little bit more work than the rest of the market to regain that momentum. Nothing to do for the time being. MKTX, again last week, testing previous levels, managed to find some demand. So what was old levels of supply up here, now starting to act as levels of demand, as evident by this recent medium-term trough. And last week also, the fact that we've got this longer tail, this longer wick on this particular candle, evidence of demand there as well. So again, if we get a little bit of market follow through there, we should see some movement to the upward side. MTN, Vail Resorts, again, relative strength-wise, has perhaps been underperforming over the last few weeks. Again, as evidenced by the tail on this one, still got a bit of work to do. our trailing stop is just about up to, very close to break even. So if we can get a little bit of a wriggle on, then that at least shows some signs of recovering. OCR has just been a plotter, but at least plotting in the right direction. So certainly a much lower volatile stock than the previous ones, and you'll see that down the bottom here. The ATRs are certainly much lower and reducing compared to a lot of the other stocks. All of this has been in the portfolio for quite a period of time, and again, if you have a look at that and think about where has this closed below a trailing 3 ATR since 2013. So for the last 2 years, it hasn't closed below a trailing 3 ATR. Go back and have a look. Were there any opportunities here where we had troughs at or above second from last peak, anywhere along here where you could have traded this particular stock? And by managing it carefully, had a fantastic return. Trading doesn't need to be difficult. Keep it simple, and that's how, again, you're going to grow that portfolio. Nice candle last week, looking quite promising, and it's certainly a bit of a point of supply over there at 260, but looking very, very good. That was the one we covered before, the ETF, which closed below its trailing 3 ATR. QLIC, again, caught up with a little bit of market weakness of late. That trailing 3 ATR, it's above its initial 2 ATR based stop. Came down, flirting with it last week. Certainly evidence, again, of demand creeping up to a higher level. Nothing to do there for the time being. Starbucks, again, one of those examples. Big move down, counter to the overall direction that we wanted this to go. But again, still closing above its trailing 3 ATR. A little retracement last week. Nice wick on that candle. And certainly if we can close above that 60 level, that's looking very promising indeed. And again, you'll see that relative strength. Certainly sticking with that stock, Starbucks looking very good. SIRO, this is an example of one, again, that breached its initial 2 ATR based soft stop, converted to a hard stop all the way down at $90.46. So at this particular point in time, if it does close below its converted hard stop, we're going to end up with a bigger loss on that trade than we initially set out to do. So again, I'll be one of the reasons for readdressing the soft stop, hard stop, and how we manage that. We'll certainly go through some examples like this one to produce again a strategy that helps you to deal with your initial stops in a more effective way, or at least I think it's a more effective way. And as I said, I'll be covering that in an education session. Total System Services, again, that's been in the portfolio for a couple of months now. One nice aspect about this, not a lot of black candles in the way it's been trailing of late. Reasonable candle last week, not much of a body, but certainly continuing to hold up reasonably well. Certainly last week its relative strength was off a little bit, but that's more to do with the eventual close on the market last week. TWC, similar sort of candle last week, pin bar with a white body there. If we can see some follow through, certainly $200 there, the old point of supply. Just need to get past there, and I think that could move quite quickly. Again, a lot of these stocks, certainly the rate at which they move is going to be dictated to a fair degree by the broader market strength. Certainly last week was encouraging the close to the market. It'll be certainly interesting to observe what happens with this market and where it gets to from here, whether we go back and retest those longer term bull market, bear market sort of filters, and what happens from there, whether we roll over back to the downward side or whether we can get a close above those levels will be the real decider of what's going to happen to this market over the longer term. VMC last week coming down and closing back nice and high. So that was a nice positive test of its trailing stop and closing high. So looking positive on that one. VR in this particular example, relative strength just struggling a little bit at this point in time. We've got our hard stop in there at 42.59, which we put in there after we breached this initial 2 ATR based stop. Certainly we had a close below our initial 2 ATR the following week. We do have a hard stop in there should price continue to move on a downward side. One saving grace is we've got a little bit of evidence of demand creeping back in there with that shadow on that particular candle. WDFC, some really nice candles the last few weeks, showing good relative strength there. Not much to do in there other than wait for that trailing 3 ATR to come up and pass our initial 2 ATR based stop on that one. So having a fairly good look through the portfolio there. WSO, a little bit weak last week. Last month, by and large, has really started to weaken off, as evidenced by a trough here and now. Wherever this trough is forming, it's going to be a lower trough than the previous one. So really, for this one to survive over the next month, it's really going to need to see some demand come back in. But certainly that. If we just go back to that one, the trailing stop, keeping us in that trade and giving us every opportunity to participate to the upward side. ULTA, again, same old story with a number of other stocks coming back down, way below its initial 2 ATR based stop. Using the old rules means that we've got to have a hard stop in there 0.5% below the low of the candle to breach the soft stop. Means we've got to have a protective stop in down at 119. I'm not happy with that, given that our initial protective stop was at 158. So again, reiterating the education session that I will run on use of protective stops and what to do when they are breached. POST was one that triggered a couple of weeks ago. Last week, certainly very bearish during the early part of the week, was able to find a little bit of strength on the back of Friday night's close, etc. Still got a fair bit of work to do on POST. And I think the last one that triggered was NVR from a couple of weeks ago. White Mountains last week, a little bit of demand coming in there. 3 ATR back up above the initial stop, so that's certainly moving in the right direction. NVR, not quite is that trailing stop up to our initial stop yet. We need to see a nice higher close. Still got a little bit of work to do there at this point in time, but the broader market will help its case, I'm sure. All right, folks, that's pretty much the extent of both portfolios. So I hope that sort of gives you a bit of an insight into what's going on with those stocks that are still in the portfolio. Certainly, the rate at which stocks have been coming out of the watch list has reduced quite significantly over the last month, which is a pleasing sign. Again, the relative strength aspect of those stocks in the portfolio has remained quite strong, which is good. And again, you really just need to have faith that if you manage your trades well, that you'll get to participate in some of those trades. Not all of those trades are going to be in your portfolio, but if you manage them well, then you at least create the environment in which you can get some of those trades that will help to grow your portfolio along the way. Any questions this morning, guys? Did you happen to find any trades yourself in either the ASX or in the US? Certainly, it was very slim pickings in terms of what was chosen from the scans, and then a closer look through those scans. There really wasn't the adequate price action on any of the scan outputs to justify any new setups. And keeping in mind that we're in extreme risk, you'd expect that likely to be the case. All right, folks. Well, if there's no questions, then continue to do the right thing. Manage your trades well, be patient, allow those trades to develop. Hopefully you've got one or two of those trades in your portfolio, or at least practicing good trade management execution, if you like, doing the right thing, allowing those trades to progress to their natural outcome. All right, thanks for that, Peter. No problem. So, yeah, I'll run another education session this week on Wednesday. Again, those of you who haven't had the chance to look at last week's, please do so. It does contain important information about on-stop levels for all future orders. Again, just recapping, 0.5% above the last medium-term peak is the new entry order. There is on the Elite Wealth website, under the ETC portal, there is a download section. So if you jump into that download section, you will actually find a trade checklist. So thanks to Kay for asking about that last week. That's been created, so you can go in there and download that as a checklist and just have it sitting next to you, or pop it into your trading plan, or have it next to your computer or whatever, just so that you're familiar with those particular rules. Other than that, we will catch up with you at the education session on Wednesday afternoon. Bye for now.